The concentration of manufacturing in the middle market, particularly in the core middle market and the upper middle market, that tends to be the result of moats that have been naturally created, either because they're asset heavy or because of proximity to markets that they serve. It wasn't justified to try to outsource and move the manufacturing offshore. And so that's remained. With the re-industrialization that's occurring in the US, I think you're going to see even more action in the manufacturing sector in both the core and in the upper middle market.
Hey folks, and welcome to Middle Market Smart, the show that brings you the best strategies, success stories, and inspiration direct from middle market operators. I'm Patrick Goulet, your producer and co-host, and today we've got a great one for you. Mike Casey. Mike's the co-founder of CXO, one of the most successful fractional executive service firms that does more than $60 million in revenue per year. He's founded a sister firm, CXO Partners, which provides middle market firms with transformational consulting services, as well as interim executive support, including finance, technology, strategy, and supply chain. Mike knows the middle market cold, including the dynamics in play, so get ready for a packed program. Let's jump right in, bring in my co-host, Bill.
Thanks, Patrick. And Mike, I am so excited to have you here today. I always kid you that you're the best connected man in the Southeast. We've known each other since the .com era, and you're probably the best business person I know as well. What I'm super excited about for our viewers and listeners is that you really are going to break down the middle market at a granular level. So it's great to have you here.
Well, thank you, Bill, for the kind words, and Patrick for hosting today. The middle market is an interesting space. It's comprised of three tiers, which I'm going to talk about, and I've got a visual to help everybody better understand it. There's about 200,000 businesses in the U.S. middle market, of which 98% are privately held. And the middle market's comprised of three tiers. At the bottom, we have the lower middle market, which is about 180,000 businesses. And these are businesses that have annual revenues from about 10 million to 50 million. Above that sits the core middle market. And there's about 18,000 businesses in the core middle market. And they typically have revenues from 50 million up to 500 million. At the top, we have the upper middle market, and these are sometimes referred to as the emerging corporates. About half of them are private. There's about 2,000 businesses in this group, and their revenues range from 500 million up to $1 billion.
Give us a little flavor, Mike, of what these types of businesses are. I imagine that lower middle market is, I don't know, regional restaurants. Maybe they have a couple of franchises or MRI imaging. What's kind of the breakdown of the different companies?
So within each of the tiers, there is a differing industry sector component makeup. For example, in tier one of the 180,000 lower middle market businesses, 25% of them are professional services businesses. And this could include accounting firms, engineering firms, marketing firms, and law firms. Another significant component of the lower middle market is retail wholesale, and that's about 15% of the tier one composition. Manufacturing is also meaningful at 15% of the tier one, and then construction follows that at 12% of the tier one composition. In the tier two sector, which is, as I mentioned, is 18,000 businesses, the makeup is similar, but with manufacturing sort of being a more significant, more than 25%, and the professional services is about 18%. With retail and wholesale, along with healthcare, coming in at about 12% of the core middle market. In the tier three or the upper middle market, they tend to operate more like a Fortune 500 business, and more than 25% of those are in the manufacturing sector, 15% in healthcare, and 15% in the tech and energy sectors. And that would include businesses like data center infrastructure, vertical market SaaS businesses and platforms, digital media, telecoms, managed service providers, et cetera.
I wanted to go back to the first slide for a second, Mike, because this is obviously weighted very heavily to that lower scale, but is one segment more, I don't know, dynamic than another? Is there more going on in terms of deal flow or M&A or just activity?
Yeah, absolutely. The core is certainly the most active, and there are really differing profiles for each of those tiers. So in the lower middle market, you're going to have some businesses that will are there and they'll remain there, like a professional services firm or a regional accounting firm, while others may graduate. If they're closer to that $50 million range, they may become attractive to a lower middle market private equity firm and move up into the core middle market, where the core middle market is where most of the action is. That's where you have more PE investments occurring, more private credit, and the emergence of consolidators that will look to bulk up and drive those kinds of returns that you see from a private equity backed business. And in the tier three or in the upper middle market, you're going to have more mature businesses. They're going to be doing the consolidation. So they may be acquiring businesses that are either at the top end of the lower middle market or just members of the core as a part of a increase in scale strategy or globalization strategy. And you have businesses that are going to be readying themselves for an IPO.
Sure. It makes sense, right? A professional services company, accounting firm, marketing firm, something like that. It's tough to scale without acquisitions, right? So we talked about Tech CXO being a $60 million company. You've, gone past kind of that lower middle market, but it's still a services firm.
Yeah, I want to weigh in on that. So one of the things we've seen in the last couple of years is the private equity businesses have invested in accounting firms. And so we are seeing more action in the professional services business where accounting firms could, raise significant sums of money to begin to buy lower middle market accounting firms or accounting firms in the core sector. And so we've seen that in several cases over the last couple of years where there is consolidation in a sector that previously didn't participate in that.
Sure. Let's look a little more closely at some of these sectors too. So clearly, manufacturing in the core and the upper middle market are high to even dominant, right? So is that because they're asset heavy businesses, and so just by their nature they're just larger, or tell me what's going on there?
Yeah, the concentration of manufacturing in the middle market, particularly in the core middle market and the upper middle market, that tends to be the result of moats that have been naturally created either because they're asset heavy or because of proximity to markets that they serve that or it wasn't justified to try to outsource and move the manufacturing offshore. And so that's remained. And with the reindustrialization that's occurring in the US, I think you're going to see even more action in the manufacturing sector in both the core and in the upper middle market.
So you're a manufacturing company servicing a certain industry group. Does it make sense to offshore? I mean, help me with that illustration a little.
Yeah, for example, I worked with a company years ago that made polyethylene bags, high density polyethylene bags, and it was located in Georgia, and it was specifically building bags for the carpet industry. And since 80% of the carpets are made in North Georgia, it made a ton of sense for that to stay here for a variety of reasons. That's just one example where proximity to market can be a moat that precludes the offshoring.
Okay. And the talk to us a little bit about the ownership of companies that are middle market companies that are PE backed versus non PE backed.
Okay, so for the PE-backed businesses, they're undergoing a period of significant heightened pressure to pursue scale and an exit, whereas the non-PE-backed businesses are going to be more focused on multi-generational stability and succession planning and lower risk strategies. The PE-backed businesses are going to be sourcing capital and looking to bulk up for internal rates of return and readying themselves for an exit. Whereas the non-PE backed businesses are going to be focused on new product offerings and domestic expansion. From a financial management perspective, the PE backed businesses, they're going to carry a greater debt loads and they're going to be pushing for that revenue growth, as I mentioned, where the family owned or non PE backed businesses, they're going to be more conservative, focusing on cash flow and scaling over time. From a technology perspective, the PE backed businesses are becoming increasingly more aggressive, investing heavily in agentic AI to try to retool the business. Whereas a family owned business or a non PE backed business is going to embrace AI, but they're going to use it to solve labor shortages or reduce administrative overhead.
So, Mike, just following up on the discussions around the PE backed versus non PE backed, for companies that might be looking to take that jump, what attributes or signals indicate it's time to bring in some outside capital or professional management?
Well, Patrick, all these businesses operate within a competitive landscape in their industry sectors, and the PE backed businesses and the capital that's being afforded those platform companies, they can change the dynamics in the sector in a manner that requires the non PE backed business with less access to capital to reconsider their strategy. And that may include looking to package the business up for an exit. It may include getting access to greater capital like private credit to begin to make those investments, which they could do without the private equity capital. And they could also pursue a private equity investment and look to become a platform company and consolidate. But it's all a function of what's going on in their sector and the competitive landscape.
So, is it fair to say that these PE backed companies are pushing or putting pressure on the private companies?
Oh, Patrick, I think it's more than fair to say they're pushing their portfolio companies. There's tremendous pressure on the private equity firms and their portfolio companies as a result of the convergence of several dynamics. Number one, the PE holding periods have stretched to a record of more than 5.8 years. And that's resulting in increased calls from the investors and the funds looking for liquidity. And number two, there's a massive backlog of unsold businesses within the portfolios of the private equity firms. And more recently, there's a liquidity mismatch that's emerged. In the last several years, the private equity funds have begun to offer evergreen funds. They've introduced their funds into retirement plans. They've sought capital from insurance companies who periodically need redemptions for liquidity. And that's changing the demand for exits. And then the last one is the IPO market's been very slow for the last few years. And that's trapped a lot of performing businesses from getting an exit. And so, what I'm seeing is an emergence of a liquidity super cycle for 2026 and 27.
Like, I want to get into some of those tensions again. First of all, this breakdown of PE backed firms versus non PE and kind of their priorities and pressure points and growth strategies. So let's start with that primary pressure. So you indicate that the PE firms themselves have an exit backlog and a race to exit, to Patrick's point, that they're being pushed. So tell me a little bit more about that.
Yeah, they're being pushed, and what's emerging is a two-speed market where the PE-backed businesses are operating at a different pace and on a different strategic trajectory than the non-PE-backed businesses. And it's really across both the financial, operational, and the talent composition of the business. For example, the PE-backed businesses, they're pursuing a platform strategy, and with some of the tailwinds coming from the one big beautiful bill, they're going to get advantages in the form of accelerated depreciation. And so they can afford, because they have access to capital, they can afford to make greater investments. They can put leverage on the business because they're getting an interest deduction, and they have access to dry powder. So they can grow faster, invest more, and buy other players in their space.
So the slow go is obviously the non PE backed firms indicate they're more interested in the legacy of the business. I assume that means family owned and succession planning and the continuity of the business, that it keeps going rather than rockets with a bunch of leverage.
Exactly. And some of the places where that shows up and the differences are going to be in operational leverage, whereas the family-backed business is going to make modest and incremental investments in AI. The PE-backed business is going to pour money into investments in agentic AI to try to drive cost advantages from their operating performance. And they're going to fetch premium valuations, which is going to make it easier for them to buy other players in the sector. And they're going to invest in technology such as digital twin technology and interconnected supply chains to lower their operating costs. And the last area where there's differing pressures and how they're showing up is in the area of talent and the gap between the family-owned business versus the private equity-backed business. The family-owned business is going to be more focused on succession, where the PE-backed business is focusing on building for an exit. And that's going to change the attractiveness of the two firms for the high caliber talent. And so the PE backed business is going to be able to grab more of the highest level of talent, which furthers their moat. And that's the kind of change to the dynamics in the sector I was talking about earlier.
I mean, is that just we are going to, you're going to hire, we're going to give you the funds to hire the best for your needs in this space, right? Whereas the non PE backed firm may be a little bit more judicious and how they hire, they may blow up their whole, their salary strategy. So,
It's right. And it's all the things I talked about earlier and the capital as a backstop. That's going to allow them to take a riskier business profile and drive the top line. And that's going to change the dynamics in their sector. And that's going to have implications to the family owned business or the non PE backed business, which could cause them to, reevaluate their strategy.
so because there's an exit backlog, what's going to happen to the valuations of some of these companies? Are going to go up, down, or maybe the activity is going to overcome the backlog pressure in terms of the value of these companies?
Yeah, I think you're going to see a heavy push for investment, debt, and additional capital, and an M&A run as these PE-backed businesses look to accelerate their consolidation play and build the platform portfolio companies out and make them larger. Where the family-owned businesses, they're going to run the risk, frankly, of becoming a digital laggard if they don't make sufficient investments because they are more constrained by capital. And that could show up as reduced competitiveness, which would show up with a more muted valuation and a likely exit in less than optimal circumstances.
Sure. Well, you're a CFO, so if I'm a family-owned business, non-PE backed, the world of debt and equity financing, M&A, rolling up an industry, for example, are those unfamiliar, kind of dubious kind of undertakings? And then what's your role in that?
Well, CXO partners, we can help on both fronts. So if a PE-backed business is on a build and buy strategy and they're looking to bulk up through acquisitions, we can certainly help on the M&A, and we can also help on re-engineering their supply chain, implementing digital strategies and AI to scale. Whereas on a family-owned business or a non-PE-backed business, we can help them access private credit. If they're interested in accessing private equity, we can help in that regard too. We can do the same things in terms of investing in technology and automation, but on a more measured pace. But we could also help them package and improve the business if they choose to pursue an exit and become part of a bigger platform play.
So it's not an imperative necessarily to be PE backed. You can get capital, you can upgrade systems, shift systems, transform your business without necessarily being PE backed. But PE backed really is an accelerant to your
It is.
competitive.
And my advice to those non-PE backed businesses and the privately held ones is focusing on the competitive landscape and evaluating your business plan while making, at a minimum, the modest investments in areas like supply chain and agentic AI.
Now, given the clear difference between PE backed and non PE backed companies, is this still valid to treat the middle market as one category? In my experience, each requires a very different approach, which makes a clearer definition increasingly important. And if that's the case, how should we rethink how the middle market is defined or segmented going forward?
Well, the way we talk about the middle market and the tiers within the middle market, it's really more about size. But I think you're highlighting an important fact, which is there's really two lanes within that middle market in terms of, or two strategies that are being fueled by different capital structures. And so I think the best way to think about it is in the same tiering, but then to talk about the dimension of the competitive landscape and the effects of the PE-backed businesses within each of the tiers and within each of the industry sectors.
Now, in terms of the services that CXO provides, or you coming into a PE backed versus a non PE backed company, what does that offering or support look like depending on the lane that you're in?
Yeah, I think by and large, there's going to be more opportunity for us to help on M&A and more opportunity for us to help more rapidly in a PE-backed business. But over time, the services that we can provide a private or a family-held business that's not PE-backed are pretty similar. It's just going to be a function of their ability to make the required investments. And it will be probably more of a challenge for a non PE backed business to become a platform company and a consolidator without access to some forms of increased capital.
So, Mike, to cap off, put on your prognosticator hat. You talked about the number of deals and capital flowing, and obviously the backlog. So, we're going to have IPOs. There's going to be more activity. And obviously, there's more interest in the middle market. Just walk us through the next, I don't know, 18, 24 months.
Yeah, I think you're going to see a significant amount of activity, certainly in the back part of 26. And there's going to, in the IPO markets, there's going to be a couple of, beacon IPOs that I think are going to bring a halo to and a resurgence to initial public offerings, and sort of unlock all that trapped capital within the private equity portfolios.
Is that things like SpaceX and, there'll be ancillary businesses that support those or
Right. Yeah. And a resurgence in the active trading. And so I think all of that will be good. I think we've, sort of oversteered too much, and really put the private equity sector into a place of challenge with all the slow access to the IPO market. And so I think that's going to change, and it's going to unlock a lot of value.
Now, with this change and with us looking back at the industries that we were talking about, which industries do you see moving up or down tiers the fastest right now with the implementation of technology with the changing landscape?
I definitely see the reindustrialization of manufacturing in the U.S. For both the core and the upper middle market being most interesting because of the supply chain initiatives, because of digital twins, because of agentic AI. I can see where these manufacturing businesses can decouple headcount and revenue scale in a way that will allow them to drive more compelling operating margins, which will translate into higher values fetched either in an exit or in an IPO.
will they look more like tech companies in terms of their valuations?
I think that's the goal. It remains to be seen how high they can get the margins, but if you can automate through agentic AI and connect your supply chain while reindustrializing the U.S., that's going to create more targets for roll-ups, and it's going to create a better operating model, and a competitive landscape globally for the manufacturing sector in the U.S.
Interesting. This is a great breakdown, Mike. Thank you for segmenting the market for us, talking about what's going on with capital and these industries and which to look out for in the next 12 to 24 months. I mean, it sounds like whether I'm PE backed or not, it's going to be an interesting time in the short, medium, and into the longer term.
It's a great time to be in the middle market.
Thanks again.
Thank you, Mike.
Thank you.